please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
The Indian currency touched yet another fresh low today, as low as 72.67 and merely rising up to 72.45 at close of day. Is this a start of a slippery slope? Is this becoming a scary slope? Hello and welcome to our special show, Rupee, the Fear Factor. I'm Lata Venkatesh. Well, the Indian currency is beginning to look scary primarily because of the events of the weekend. First up, today in early trade, while the offshore market, where, what you call the non-deliverable forwards market showed that the rupee may not fall so much, at the start itself, the rupee in the domestic market started falling more simply because there was a goodish bit of importer demand. So clearly it's domestic market that's buying the dollar in a bit of a scare. The other reason why one is a little worried about the fall today is that over the weekend, the government started talking up the rupee. Until now, you heard Finance Ministry largely saying that, a fall is welcome. It corrects the deficit and the market knows best and the RBI knows best. Now, clearly, the government thinks that enough is enough. RBI actually walked the talk. While the government said that the rupee had fallen enough, both on Friday and on Monday, we hear from dealers that there was a goodish bit of dollar selling by the Reserve Bank. The rupee did go off lows, but at higher levels, it continued to find selling. And hence this fear, and is this now getting to be a slippery slope? Let me quickly tell you the global ambience in which this is coming. It's not very positive. This does look like an emerging market contagion, as we have put it. There are two things which are roiling emerging markets. The trade tariff talk is pushing emerging markets down because a lot of Asian EMs are actually suppliers to China. They're part of the supply chain, and therefore a further $267 billion of tariffs on China doesn't bode well for them. The other factor hurting EM currencies is the possible strength in the dollar because of the strength in the US economy. The very strong jobs data that we saw push the dollar index up a bit, and that always means that EM currencies, in comparison, will fall. And, now it is actually two factors. In the days of yore, whenever the US economy did well, like in the 2003 to 2007 period, as the US economy grows, Asian EMs are able to take a strong dollar because they're exporting to this big economy. But now with the US economy growing but saying that we don't want goods from EM countries, it's a double whammy for currencies like, the Korean won. The Korean won fell rather sharply today, 0.6. And of course, the other currencies, the peso, the rupee, have all been falling. I mean, forget the month to date. Look at the year to date fall. Rupee has fallen 13.4%. The other currencies, Korean won, 5.7, peso, 7.7 or 7.8. That's the Filipino peso, not Argentinian peso. I'm only comparing it to Asian countries. And then we come to the others. With this company, we look a little better, of course. But we don't want to look better than just these guys. We want to look better than Asian currencies. So the Brazilian real, the South African rand, and the lira are, of course, much worse. But the Indian currency, being the worst performer in the Asian EM basket, is that a spot of bother now? Or is it just making up for, the last 3 or 4 years of very good performance? And, therefore, in comparison to 2013, for instance, we still look very good. Should we be happy or should we be scared? Let's ask the first of our experts. We've got actually a band of experts joining us. First up is B. Prasanna, Head Global Markets at ICICI Bank. Prasanna, thank you very much for joining us. That really is the first question. Should we just, until now, both from North Block and in the markets, economists were telling us, yes, we were too steady for too long, and now we have to correct, fall a little to correct our trade deficit. Are we overshooting, or are you still comfortable?
So, Lata, I was hearing your opening commentary just at the beginning of the show, and I think you hit the nail on its head. Basically, it's a double whammy which is going on. Something that I wanted to say, actually, you hijacked what I wanted to say. So you have, over the weekend, the strong non-farm payrolls data which came out of the US, which actually led to the US index appreciating, the dollar appreciating over all other G7, G3 currencies. And then basically because the growth is expected to be very good in the US, and not only the labor data, but also the wage growth came on the higher side, basically indicating that the Fed is going to be on its, very much on its trajectory of hiking rates, possibly 2 more this year and 3 more next year. These things are still not priced into the rates market as yet, as well as into the dollar market as well. So you have an appreciating dollar on one hand, which effectively, I mean, it's a economy, US economy, which is doing well. And like you rightly said, normally it means very good growth for emerging markets, and hence it means countries like India should be doing very well. But unfortunately, what we have on the other hand, along with an appreciating dollar and a rising rates, is the fact that there is a huge trade war which is blowing out. You really don't know who are going to be the winners and losers in this. Of course, it is a US-China trade war primarily, but there are going to be a lot of ancillary players because there are a lot of people in the global value chain which provide imports and exports to the Chinese economy as well as to the global economy. So it is really a concoction of sorts, and because of which the entire flows into emerging market is getting questioned, and there is a reassessment of the various asset classes by the foreign investors at various places. So this has kind of led to a big sell-off in emerging market currencies this year, and which is actually accentuated in the last 1 month. So if you really look at this year, you would see that, I mean, countries like Argentina and Turkey has possibly done the worst.
Yep.
They have probably depreciated 60% to 40%, depending upon which country you take. Yep. But then if you take the other countries like Brazil, Russia, and South Africa, they have also appreciated in the high teens, 18%, 19%. Yeah. So India was in the low or in the high single digits till around last week.
Sure.
But right now, I think if you calculate the depreciation, it would be in the region of 11 to 13, 12 to 13%, depending upon what you look at.
Prasanna,
so the point...
I want to interrupt you here because, I take your point that now we are beginning to look a little bad if you look at double-digit percentage fall. I have a bunch of emerging market experts joining me a little later on the show to discuss the EM context. But I'm really worried about the India context, and you are best placed to answer that. See, there is a double whammy hitting Indian economy because of this. There are some companies which are deeply dependent on imports or have FCCB, ECB exposures. And also, where did the bond yield end today? 8.16. So do you think now there is a self-fulfilling negative for the Indian corporate sector?
So, Lata, what we are going through right now is the reverse of a virtuous cycle, vicious cycle, if you want to call it. So, you don't know, all asset classes are falling, and you don't know which one is driving what. So, I mean, equity is falling, currency is falling, and bond yields are looking at both those markets, and yields are going up. And then at somewhere, yields are going up, and equity is falling, looking at the bond yields going up. So, this is become a very vicious kind of a cycle. And but like you rightly also said, that the government has come out with very, very positive statements over the weekend, saying that they are not really appreciative of this extent of rupee depreciation, which is a slight change from the kind of narrative that they were talking about last week, which was to say that they were probably comfortable because it was a global market phenomena. So to some extent, see, you can't call in the market what exactly is the right level, or even if you were to know or have in mind what a right level is, you cannot expect the market to exactly stop at that level. Obviously, markets are being markets. They will overshoot or undershoot. And we had, over a period of time, over the last 4-5 years, consistent periods of time when we have current account deficit, but we were supported by the foreign flows, and hence our rupee did appreciate. So you could possibly say that we are catching up for the past lack of depreciation that happened in a few years. So it's a mix of all these factors that are really going through. And I think market at some level would possibly find a fair level. Say, even right now, I can tell you a lot of foreign investors are looking at bond markets with an attractive eye. They want to get into the market, but they're saying that let the currency market stabilize. So clearly, one asset class is driving the asset class. If there is stability in the currency market, I'm sure that there will be some kind of inflows which will come back in. So what the currency market incidentally is doing to the bond markets is there is some kind of a doubt which is coming into the market's mind as to whether a repeat of 2013 is likely or not. not, which is an interest rate defense. So if you see last time around, it was first the RBI did the interest rate defense first and then came out with the FCNRB deposit scheme later on. So the fear in the minds of the bond market participants today is this currency fall going to lead to some kind of a rethinking from the Reserve Bank from an interest rate perspective. Ironically, we are in a time when inflation is quite comfortable. I mean, in the sense that, of course, it's 5, which is still higher than the 4, which RBI is targeting. But it's not that it's a runaway inflation. Absolutely. So the net rate hike is not going to happen due to inflationary expectations going out of bound. It's possibly, if at all, going to happen because of the financial instability caused by the emerging market crisis and the rupee depreciation.
Okay. Well, personally, would you endorse either of these positions or even expect them from the Reserve Bank? I mean, we have $428 billion of reserves. I mean, is this just wishful thinking by some of the foreign banks who made money hand over fist last time around at the NRI bonds were issued in 2013? Either of these out-of-turn hike or bond, is that on your radar at all? Are you expecting it?
So if your question is that is an FCNRB kind of a scheme which was given out in 2013 likely this time? So I'm sure, I mean, I have to repeat what the government official said, which is that all options are on the table and they've included FCNRB scheme also as one of the possible solution. But in my pecking order, I would possibly place things like measures to improve the current account deficit, like measures to, bring down imports and encourage exports. Any of those measures should come first. Oil window, currency window for the oil companies separately from Reserve Bank of India, that will probably come second. And then somewhere in between, you can also think about the Reserve Bank of India intervening more aggressively in the spot market by using its reserves to sell in the spot market, and also doing a bit of buy-sell swaps, which is to receive forwards in the forward market to postpone the liquidity suction to a future date. So I think these three, mix and match of all these three, I would say is a little on the higher probability when compared to an FCNRB scheme. But the FCNRB scheme also, as told by the government official, seems to be very much on the cards.
My sense is that a large part of the market is reading the Reserve Bank or expectation of the Reserve Bank exactly as you are saying, that more likely expectations of some action from the government on the imports and exports front. But very quickly, Prasanna, a quick last question, and please try and answer me with some specific ranges. What can be the worst for the rupee? What is a likely equilibrium that you are expecting? And likewise on bonds, is 8.16 bad enough? What can be an overshoot?
No, Lata, it is very difficult to give a specific answer for that. So like I said, markets being markets, they do overextend, so it's very difficult to figure out how much overextension can happen. All I can tell you is that at around 72.5, on a RER basis, the data is still not out, but on a RER basis, I suspect they're at around 10 to 11% overvaluation, which has been the long-term average. But of course, you can argue that long-term, it's only a long-term average, and you can always go towards 107, 108, which basically means that we go towards 73, half, 74. So I'm not saying it will happen, but it's very much possible. And on the yield side, like I said, see, bond market players are living by the day, and they come in the market, see where oil is and where dollar rupee is going to open, and then they play the bond market accordingly. So clearly, as you come every day and you see oil higher, oil has been higher by around 8 to 10% over the last 1 week to 10 days. So as you see oil higher, and as you see dollar rupee not stabilizing, bond yields will go up. So who's to say what is the fair value? Is it at 8% or 7.75? Okay. Probably a lot of us thought 7.75 to 8 was a fair value, considering 6.5 as the repo rate. By the way, the swap market today is now pricing in 3 rate hikes within the next 1 year. 2 rate hikes in the next 2 policies, plus a 3rd rate hike somewhere 6 months to 9 months down the line. Okay. So as oil goes up, as dollar rupee appreciates, the rate hike expectations is also going higher and higher in the swap market, and this also feeds into your bond market selling, which is happening currently.
Absolutely. Opinions don't make markets as much as markets make opinions, right? Thank you very much, Prasanna, for joining us with your take. So things can get bad simply because, the global ambience in which the rupee and Indian bonds are playing out is now shifting. Exactly that after this very short break. We're going to have 2 guests with us, Nick Parsons and Gareth Leather, to discuss with us how is the global EM scenario and the global scenario playing out Are we going to see more currency instability? That question in a minute after this break. Welcome back to our special show, Rupee, the Fear Factor. We just discussed how the Indian markets are viewing the fall in both bonds and the Indian currency. Joining us now are Nick Parsons, Head Research and Strategy at Thomas Lloyd and Gareth Leather, the Senior Emerging Markets Economist at Capital Economics. Gentlemen, thank you very much for joining us. Nick, well, first to you. You were telling us when we spoke last week that you think the rupee is much stabler than other Asian EMs, and that when the dust settles, people will wonder why the rupee was sold off so much. The rupee has since lost a further 2%. Are we in overshoot terrain? How bad does this get?
Well, we said when the dust settles, they will look at the value in India. And what is very clear is that across the EM universe, the dust hasn't settled yet. You know, here we are, we're less than 10 days away from a US rate hike. We've had strong US numbers on Friday in the jobs with the jobs report, and still investors are preferring the dollar over the EM universe. I think the question's got to be, why has India underperformed the rest of EM, rather than just why is the EM universe under pressure? And that's where the puzzle is beginning to lie. Because let's remember, India is now the 6th largest economy in the world. This is not just a tiny EM story. It's the 6th largest economy in the world. We've got bond yields at 8%. We've got a currency which has already fallen 11% this year. And so let's throw this forward and say, how bad do things have to get before people really want to buy into this story? Now, if you look at the 5-year forward rate, 5-year forwards are just approaching 90 to the US dollar. So if you think the rupee is going to be below 90 in 5 years' time, then you must be buying bonds. It's not the case that you must be buying equities, but the fixed income market's starting to look very attractive indeed.
Oh, well, that at least will be music. If some people start thinking that way, then of course you're going to have a bit of a appreciation or a correction in the rupee. But Gareth Leather, let me get your view on emerging markets itself. Now it looks like a double whammy. Until now, whenever the mother economy, the US economy, grew and you had such a strong jobs data, like we did way back in 2003, 4, 5 and 6, the Asian economies celebrated because they were exporting to that country. Now, you know, you can't export as much because of the tariffs and the threat of more tariffs, another $267 billion. Do you think this double threat will mean more discomfort? How much more can emerging currencies fall?
Yeah, we still think the sell-off in Asian currencies still probably has a bit further to go. If you look at the factors that have been weighing on them this year, you've got rising US Treasury yields, you've got the trade war between the US and China, and you've got contagion from the crisis in Argentina and Turkey. Now, we don't see either of those going away anytime soon. So if those are the factors that are driving Asian currencies lower, then it makes sense that they've got further to fall over the next few months, we think.
Okay, so what would you say can be can the dollar go to? The DXY about 95.5. Does it approach 100? What is the number in 2018?
Well, I think we're certainly a long way from that. The sell-off this year, it's been 10%, but if you look at it in a kind of trade-weighted terms, it's much smaller, something around 5% or so. So a lot depends on what happens to the dollar over this period. But we don't see, anything approaching 90. We think that's kind of way off target.
Okay. What about you, Nick? Do you think we're going to see a lot more dollar strength? Because at least immediately the dollar strength, the DXY strength is a matter of concern for EM currencies.
I think near term the dollar may have just a little further to run. The catalyst, I think, for a decline will probably be a change of view on the part of the US administration, and then further down the track, a change of view on the likely path for US interest rates. because you'll find it very difficult to find an analyst who doesn't think that the US will raise rates another 4 times over the next 18 months. That is consensus, that is baked into the price. Okay. Once that becomes challenged, once that becomes open to more debate as we move into the start of 2019, then I think we could look at some respite for the EM currencies and the dollar coming off the boil. So I think this may have just a little bit further to run. But my contention for a few moments ago, and I'd repeat now, is that an awful lot of bad news is priced into India, and there's still an awful lot of protection to be found in the yields. Now, I don't think that that same logic applies to the equity market, which is still the world's best performing equity market in 2018. What we perhaps may have to look for is signs that overseas investors begin to exit their equity positions. At that point, they've got no currency left to sell. And rather than looking at the equity rather than looking at the currency market for clues about equities, what we perhaps should be doing is looking at the equity market for clues about the currency.
Okay. Well, actually, there have been a decent amount of foreign portfolio selling in Indian equities for some time now. It's not been massive, but it's been in a trickle. But it's been for a better part of 2018. Gareth Leather, what's your sense? Do we need another external event, like either the Fed saying something, or US and China smoking the peace pipe, or some big data indicating global slowdown for the EM currency to stabilize?
I think you probably need something like that. It's just that we're not anticipating it to happen straight away. I think at some point investors' expectations on US interest rates will change, but I think we've got a few more rate hikes in the US first. The crisis in Turkey and Argentina will probably at some point start to dissipate, but probably not in the immediate term. I think in terms of the trade war between China and the US, I think there's a risk there that that could continue for quite a while longer yet, and I think that will continue to weigh on sentiment.
Gareth, if you heard what Nick Parsons has been telling us, he thinks India in particular, the currency and the bond markets are indicating fairly decent value at this point in time. What's your sense? Going by Indian macros, has the rupee corrected enough and are bond yields attractive enough to bring in portfolio investors?
They possibly are, but I think that the big picture is that if you've got this continued sell-off in EM assets, then it's difficult to see India outperforming against this backdrop, especially given you've got the current account deficit, which continues to weigh on investors' minds.
Okay. Yeah, that is there, but the chief culprit over there really are crude prices. And now, you are multiplying probably close to $78 of crude today, 77.5 with 72.5 on the rupee. So that's a big burden for the country. What's your sense in terms of even oil prices? If there is going to be such kind of a tariff war and some quietening of EM growth, do you think oil prices can, go beyond 80, or do you think they are at fair value now?
Our forecast is them to fall a little bit over the next few years, but nothing dramatic enough to kind of substantially change India's external outlook. That, given the likelihood of slightly slow growth in the US and China, we think that will probably weigh on demand, and then increased production in the US will probably boost supply. So you've probably got a slight fall in the oil price over the next couple of years, but I don't think that's going to change the big picture for India, really. Okay.
Well, Nick, a final question to you. Do you think we would be in the midst of some accident? Until now, we've seen, very isolated accidents, like, for instance, within Turkey or within Argentina. It's not, while it is a contagion of sorts, it's not a disastrous contagion. Do you think we are on the brink of something that can be really bad?
It's not my sense, no. I think there are idiosyncratic stories pertaining to individual geographies, but I don't think this is the sort of contagion which ought to drag India down with it. As I said, India is the 6th largest economy in the world. It's going to grow somewhere between 7 and 8% this year. 72 out of the last 74 quarters have produced positive economic growth. And I think when we look at India in comparison comparison to the developed economies rather than it just being lumped in with the rest of the EM universe, then I think the protection that is already offered there in terms of yield and the extent to which the currency also already has declined is going to make it one of the more attractive investment stories going forward.
Okay. Well, I'm sure this is going to be music to the ears of both the government and the Reserve Bank and a lot of people who are long on the rupee because of their sheer exposure to the Indian economy. Gareth Leather and Nick Parsons, thank you very much for joining me with your perspective on emerging markets and on the global economy. With that, we wrap up this special coverage on Rupee, the fear factor. Thank you for watching.